Hello and welcome to today's edition of Citrus Bites from our offices in Sevenoaks. As always, a couple of bits of economic information from me and then a couple of questions that I'm going to pose to today's guest. So today I thought I would start over in America, where many of you may have seen news about the US debt ceiling. So what is the debt ceiling and why is it important? Well, the US debt ceiling, the best way to think about it is probably thinking about your current account and having an overdraft on your current account. The US debt ceiling, which is typically the amount of borrowing the US government has, currently stands at over $31 trillion. And it's a staggering amount. $31.381 trillion is the current US debt ceiling. It's actually increased 102 times since World War II. So actually, that's the amount of money that the government is able to spend on a monthly basis, covering many of the debts, the bills the government needs to pay. Why is it important? Well, actually, as it stands, the government is unable to go above the current debt ceiling. And that would mean, and the forecast believe that's from the beginning of June, it would mean that the government is unable to meet its current obligations. Now, that would be huge news for the US, mainly because the US has never, ever defaulted on a debt payment. Therefore, it means the government is able, for example, to access money much cheaper than many other countries would be able to, because from an investment perspective, it's seen as a really safe place. So what's the consequences if Congress are unable to agree an increase to the debt ceiling by early next week? Well, many economists believe that would create an immediate global recession. Such is the strength of belief over the way that the US has never defaulted and the impact the dollar has on the worldwide currency markets. So it's a really important topic. You're probably going to hear more about it, but with only a few days to go now, it really is going to the wire for Congress to be able to agree an increase to that current debt limit. Back to the UK at the moment. For those of you that saw my video back in February, you'll have heard me talk about the IMF, the International Monetary Fund. They announced their views over the prospects for the UK economy in 2023. And frankly, they weren't great at all. They predicted that the UK would be the worst performing economy in all the G7. In fact, that the economy would perform so badly, it would actually perform worse than Russia, where there's obviously a war going on. So how are they actually doing against the forecast that they made back in February? Well, in April, they came back out and said, things will be bad, but they're not quite as bad as we thought they were going to be back in February. But we're still expecting the economy in the UK to shrink in 2023. Just a few weeks later then, in May, they've come back out with a further update to go, actually, we're going to change it again. And it's not going to shrink like we said it was going to in February and in April. We now realize the UK economy is going to grow in 2023. So in theory, that's great news, a stronger UK economy. Well, perhaps. And now we get back onto our favorite topic at the moment, which is inflation, because that's another driver, obviously, and we know the consequences of high inflation, and we'll talk about those on interest rates. But in terms of the latest inflation results, the good news is that actually month-on-month CPI, so when you look at April to May, we've seen a decrease in that year-on-year CPI. So when I spoke last month, I was telling everyone about a figure of 10.1% year-on-year. The good news is that's dropped to 8.7% in May. So a nice drop. Now, not to be confused, that doesn't mean prices are going down. It means that actually prices are just going up by less than they were in April. So a positive story. On the flip side, however, we've got this actual kind of core CPI, so core inflation. And I explained in my last video, core inflation excludes some of these really volatile items such as energy and food that make a really big impact on these month-on-month numbers. So has core inflation gone down in line with the CPI figure I gave you before? And that answer is no. So this sticky inflation, which is the core CPI, that's gone up again this month from 6.2% to 6.8%. So that sticky inflation is still putting pressure when it comes to interest rates. So you may remember last month, or most recently in May, the Bank of England announced the 12th consecutive increase on UK bank base rate to 4.5%, thinking, and again, hoping perhaps that that would, really start to make a difference to inflation. But at the moment, what we're seeing is that sticky inflation carrying on. So of course, that leads us to so what will the Bank of England do next when they meet again? Are we facing a 13th Bank of England rate increase on the bounce up to 4.75%? And could actually there be more to come even after the June meeting? So that's the latest inflation. That's kind of some of the information that the Bank of England is going to be reviewing ahead of the meeting on the 22nd of June, when again, they'll have the very latest inflation data. So next month, no doubt, we'll be able to see what's happened and talk about what the next move might be when it comes to July. So a potential Bank of England base rate increase for those on tracker mortgages, for those on standard variable rates, typically means, therefore, they'd be facing, if there is another rate increase, they'd be facing another rate increase. So one of the things I came across recently that stood out for me was a very interesting article talking about 100% mortgages, which struck me as quite interesting, bearing in mind the number of rate increases and therefore the pressure on mortgage payments that many consumers are feeling at the moment. And in fact, thinking how many years had it been since I last saw perhaps 100% mortgages, and it made me think about the Northern Rock. So for those of you that aren't familiar with Northern Rock, go away and pop the Northern Rock in your search engine and you'll see what happened to the Northern Rock. But so 100% mortgage is what I read about. So this is probably a good time for me to now hand over to our guest today, and I'm delighted to welcome Holly Bettles, Mortgage and Protection Advisor.
Hi, Richard.
Hi, Holly. Thanks for joining us.
No.
So 100% mortgages, was I right? Or did I really read that correctly?
Yeah, you did, but it is a slightly different take on 100% mortgages, which, compared to the Northern Rock is probably not a bad thing, as you pointed out. So yeah, basically Skipton, one of our lenders, has said, look, we think we should have a shift here, something that a lot of people have been petitioning for a long time. And it's the link between mortgages and mortgage payments and rental payments. And actually, how can we help what they're calling generation rent turn into generation homeowner? And so the idea behind them is, rather than, oh, yes, no problem, just go and buy somewhere, you don't need to save anything. Actually, it's looking at how difficult it is for renters to be able to save a deposit, even a 5% deposit, and pay their rent at the same time. And how do we actually go, you've always managed your rent, you've always managed your home bills, you've never fallen behind, and therefore if your rental payment is going to be more expensive than your mortgage payment, why can't we help you and get you on the property ladder? So that's the basis of it. So they've been very careful about it. I think they've done a really good job as far as their due diligence is concerned, looking at the criteria and how you'd be able to apply or not. And the very top level of that criteria, there is lots of it, but the top level is that it's for first-time buyers only. So you can't ever have owned a home here or abroad. You need to have been renting consecutively for the last 12 months out of the last 18 months. And you have to be able to evidence that you can have paid all of your household bills. And then you've got the level of making sure you don't have any, missed commitments, defaults, that kind of stuff. So they are saying, look, this is going to be for a specific type of client, but it's for those people who have evidence that they can manage their finances, they can manage all their household bills, and they are then able to actually go, well, if buying somewhere is going to be cheaper a month for you, you're a good bet. And therefore, why not give you a chance, basically? And a few other things, you have to be over 21. You can't buy a house over £600,000. So depending on where you are in the country, that might or might not be a problem. And if you do have a deposit, you can put it towards it. But they say, look, if you've got more than a 5% deposit, you're better off going and getting a different type of mortgage anyway, because that one's not really going to be for you. There'll be better rates elsewhere. But that's the kind of overview of it. They are being very careful with who they lend to and how they do it. But they're just saying, look, we know how hard it is to save for a deposit when you're paying rent every month. Let's see what we can do.
Brilliant. Okay. Thank you for clarifying that. Really helpful. Thanks, Holly. And the other thing I've been reading recently, I saw an article on the BBC, and actually it was talking about, for every 13 people in work in the UK, one person's on long-term sick. And that really stood out to me, that number. And of course, then I was thinking about people who had taken mortgages and thinking, you know, well, okay, for people who have taken mortgages or are thinking of taking mortgages, do they have options to protect them in the event that, you know, they are one of the unfortunate people who do end up long-term sick?
Yeah, absolutely. And it's something that, you know, we would cover off when having a conversation about a mortgage. If you've taken a mortgage out, we've worked out how much you can borrow based on how much you earn, you know, and a few other factors, obviously. And if that earning potential and that earning capability is taken away from you, and that's not something you can choose, you know, some people would like to maybe not have to go to work every day, but actually if that's taken out of your control, then you need to have a plan B. And your plan B is having some form of income protection. You know, there's been lots of different types in the past, but actually the offering that providers are able to give us now is very comprehensive. You know, it's great. And it just means that should something happen that you are not anticipating and that is out of your control, and you are no longer able to bring those funds into the household each month or each week or however it is that you get paid, there's a fallback plan there where you can activate that insurance policy that you've taken out, and they will pay you a certain percentage of your wages, so you can pay your bills and you can pay your mortgage amount, and that will continue for however long or whatever type of policy you've taken out until, you know, you're able to go back to work or you retire in some instances. But it's just thinking about, I earn this money now and that pays my mortgage and my bills, but if I can't earn it, I need to make sure I've got something to fall back on.
Fantastic. Okay. Thank you for that, Holly. Appreciate the information. And then you are going to receive the question that Neil set last month as well. As always, people that haven't watched Citrus Bites before, there's always a question that the previous guest kind of talks about, then the current guest will answer it. So the question that Neil asked last month, Holly, was, when thinking about future finances, how far in the future do you look and why?
Okay, interesting question. So if I'm looking at this from a mortgage and protection advisor perspective, for me, there's a couple of different bits. So there is your credit rating is a massively important part of being able to get a mortgage. And anything that hits your credit rating is going to stay on there for the next 6 years. So although that might seem a little bit, you know, crazy to be thinking that far ahead, you know, one of the things that I said to my brother when he was younger was, whatever you do, go out and have fun, but do not ruin your credit rating by doing it. And he always comes to me and says, I wouldn't have a house unless you'd warn me about that, because I probably would have gone out and done crazy things and just thought I'd pay it back later. So if we're thinking long term, definitely protect your credit rating, because anything that goes on there will stay on there. We can't hide that and get around that. Short term, make sure you've got nice clean bank statements, you're not missing monthly payments. And also if you're looking to save for a deposit, although we have got the 100% mortgages, there are other options as well. So if you're thinking future finances, you know, think, how much do I need? What will I need to put aside each month? And you know, ask a mortgage professional, you know, what route should I take to do this?
Brilliant. Okay. Thank you very much for answering that. And then you get the pleasure of being able to set a question for our next guest. So what question would you like to set?
I would like to know what the favourite part of our next guest's job is. What's the bit of their job they enjoy doing the most?
Brilliant. Okay, Holly, thank you very much. I'll be sure to ask them that next month. Thank you very much for answering those questions today. We're timed out. Thank you very much, everyone, for watching, and look forward to seeing everyone next month. Take care.